Hello everyone, welcome back to Boss Economic World. I'm your host, here to peel back the skin of the financial onion, wipe away the tears, and show you the cold, hard cash hiding in the center. Or, in today's case, show you that the onion might just be a hollow plastic prop from a reality TV set. Today is November 26, 2025. Thanksgiving is tomorrow, but if you listen to the White House, Christmas came early and Santa brought a bag of money so big it would crush a reindeer. President Donald Trump is taking a victory lap. And not just a lap, he's running a marathon on the front lawn. He claims he has secured $21 trillion in investment pledges. Yes, you heard me right. Trillion. With a T. Let's put that number in perspective. That is nearly 70% of the entire annual economic output of the United States. If this were true, it would be the single largest explosion of capital spending in the history of the planet. It would dwarf the New Deal. It would make the 19th century railroad boom look like a couple of kids playing with Legos in a sandbox. Standing next to Saudi Crown Prince Mohammed bin Salman last week, Trump beamed and said, "We're doing numbers that nobody's ever done." But here at Boss Economic World, we have a rule: if the number sounds like a fairy tale, check the math. And folks, when we check the math on this $21 trillion gold rush, things get interesting. Is this a historic economic renaissance, or is it the world's most expensive game of Simon Says? Let's dive in. First, let's look at the official scoreboard. The White House has launched a shiny new webpage called the Trump Effect. It lists $9.6 trillion in total U.S. and foreign investments. Wait a minute. Trump says $21 trillion. The website says $9.6 trillion. Somewhere between the Oval Office and the web server, $11.4 trillion just evaporated. That's more than the GDP of Germany and Japan combined, lost in the sofa cushions. But let's be generous. Let's look at that $9.6 trillion figure. A deep dive analysis by Bloomberg Economics and verified by our team shows that the actual, hard money investment pledges are substantially smaller. We are looking at roughly $7 trillion in what economists might charitably call real investment intentions. Now, don't get me wrong. $7 trillion is a mountain of money. It's more than all the foreign direct investment accumulated in the US since we started counting beans. If delivered, that's about 5% of GDP annually. That's huge. But here is the punchline: a pledge is not a check. In the corporate world, we call this the price of admission. CEOs and foreign leaders have cracked the code. They know that to get what they want from the Trump administration, whether it's tariff exemptions, AI chips, or just avoiding a mean tweet, they need to walk into the White House and shout a big, beautiful number. Take Mark Zuckerberg. In September, he was caught on a hot mic at a White House dinner, a rookie mistake for a tech genius, apologizing to the president. He said, and I quote, "I wasn't sure what number you wanted to go with." This is the CEO of Meta, asking the president what number to write on the imaginary check. He later clarified a $600 billion pledge. CFO Susan Lee, the poor woman actually responsible for Meta's balance sheet, had to tell investors, "One of us is a CFO, and one of us is a builder and tech visionary." Translation: the boss is making up numbers, please don't sell the stock. This is the Trump premium. It's an inflation of promises. And it's happening everywhere. Let's look at the international players. The White House list is dominated by eye-watering numbers from the Middle East and Asia. We're talking trillions from the UAE, Qatar, and Saudi Arabia. But let's analyze the truth behind these investments. The White House claims a $1.2 trillion commitment from Qatar. Sounds great, right? Qatar building factories in Ohio? Not quite. The fine print describes this as a plan to generate an economic exchange. That includes trade. Here is a basic economics lesson: trade is not investment. If I buy a car from you for $50,000, I have not invested $50,000 in your household. I just bought a car. Yet, the administration is counting purchase commitments, buying U.S. weapons, aircraft, and corn as investment. Look at the Saudi pledge. Trump hailed a $600 billion deal on November 18. The very next day, he asked them to bump it to $1.5 trillion. Saudi Arabia's entire GDP is only $1.2 trillion. Trump is essentially asking them to pledge their entire national economy plus a tip. In 2017, during Trump 1.0, the Saudis promised massive investments. Official statistics show that by the end of 2024, Saudi direct investment in the US had risen by a whopping $5 billion. The gap between the headline and the reality is the difference between buying the Dallas Cowboys and buying a ticket to the game. Then there's the United Arab Emirates. They pledged $1.4 trillion. Why? Because they desperately needed access to US-made AI chips, which are under strict export controls. The pledge was the ransom payment. Let us buy the chips, and we promise to spend $1 trillion, eventually. It's a geopolitical bazaar. You pledge a number, I give you a permit. Whether the money actually moves? That's a problem for the future. Why are companies playing along? Because fear is a powerful motivator. The administration has threatened massive tariffs on imports. If you are Apple or a pharmaceutical giant, the US is your biggest market. You cannot afford a 20% or 60% tariff. So, Tim Cook goes to the Oval Office in August. He adds $100 billion to an earlier pledge, bringing Apple's total commitment to $600 billion. Let's do the math on that. $600 billion is roughly 5 years of Apple's profits. It is wildly more than their annual capex. How do they get to that number? By counting everything. Supplier payments, employee salaries, the cost of electricity to run the lights at Apple Park. As Patrick McGee, author of Apple in China, noted, Apple's a big company, but they're not that big. Tim Cook isn't investing $600 billion in new factories. He is investing in a tariff exemption for the iPhone. And guess what? It worked. Trump declared Apple exempt from semiconductor tariffs immediately after. It's the same story with Japan. A $550 billion pledge brought down the tariff rate on Japanese exports. But when you ask Tokyo where the money is coming from, they get quiet. It's likely loans and export guarantees, not new factories. This isn't capital formation, it's protection money. It's the cost of doing business in the new boss economic world. Now, I want to be fair. Not all of this is smoke and mirrors. There is one sector where money is actually being shoveled into the ground at a frantic pace: artificial intelligence. If we strip away the vague sovereign promises and the tariff shield pledges, what's left? Data centers. Power plants. Chips. Bloomberg Economics estimates that the AI investment boom is real and could add a full percentage point to US growth this year. Pledges from Nvidia, Amazon, Microsoft, and Google make up the backbone of the real $7 trillion figure. But here is the irony: this boom started under Biden. The CHIPS Act and the initial AI frenzy predate the current administration. Trump has simply poured gasoline on the fire. And now, we are facing a new problem: the bubble. Fed Governor Christopher Waller, who might be the next Fed chair, said it bluntly last week: if you take out all the AI investment, business fixed investment is turning down. That is the scary part. Domestic fixed private sector investment was flat in the first half of 2025. The broad recovery isn't happening. It's just AI. And this AI boom is hitting physical limits. We are running out of electricity. Data centers are standing empty because the grid can't power them. Project Stargate, the massive AI supercomputer project, is facing delays. Concerns that AI is a bubble have already shaved $2 trillion off the S&P 500 since late October. If this bubble bursts, the Trump boom goes from a historic expansion to a historic recession overnight. Furthermore, this investment is capital intensive, not labor intensive. Building a data center requires a few hundred construction workers for a year, and then it's run by a handful of technicians and a lot of air conditioning. This is not the manufacturing renaissance that employs millions of blue-collar workers. To understand the risk, we have to look at history. Do you remember Foxconn? In 2018, Trump called their planned Wisconsin factory the eighth wonder of the world. It was supposed to employ 13,000 people. What happened? The project collapsed. They hired a few hundred people. The buildings sat empty. Today, ironically, Microsoft is building data centers on that exact same site in Wisconsin. It's a perfect metaphor. The manufacturing jobs promise failed, replaced by the automated AI infrastructure reality. The White House is also claiming credit for projects that are essentially reshuffling the deck. Look at the auto industry. Trump hates electric vehicles. He cut the subsidies. So, automakers are canceling EV battery plants and announcing investments in combustion engines. The White House lists these as new investments. They aren't new. They are reallocations. Money moving from the left pocket to the right pocket. Elizabeth Creer from the Center for Automotive Research calls it rebalancing, not a surge. In fact, nearly $67 billion in clean energy projects have been paused or cancelled since January. That's negative investment. But you won't find that on the Trump Effect webpage. So, what is the verdict? Is the US facing a $21 trillion tsunami of cash? No. Is it facing a $7 trillion boom? Maybe, but only if you count stock buybacks, routine operating costs, and defense purchases as investment. Here is the reality of the economy in late 2025. 1. The numbers are political. The $21 trillion figure is a marketing gimmick. It mixes trade, loans, and vague promises into a big number salad. 2. The Trump tax is real. Companies are pledging billions to avoid tariffs. This distorts capital allocation. Instead of investing where it's most efficient, companies invest where it pleases the president. 3. AI is the only game in town. The entire US growth story right now hangs on the AI boom. If AI delivers on its productivity promises, the economy could soar. If it turns out to be a bubble, we are in trouble. 4. Luck is a factor. As economist Ishwar Prasad points out, Trump inherited an economy with momentum and a world in shambles. The US is the cleanest dirty shirt in the global laundry basket. Investors are here because everywhere else, China, Europe, looks worse. The boss takeaway is this: optimism is an asset, but delusion is a liability. Trump is betting that by shouting $21 trillion loud enough, animal spirits will take over, and the fake pledges will turn into real money. It's a confidence game. And in economics, confidence matters. But for you, the investor, the worker, the citizen? Watch the fixed investment data, not the press releases. Watch the power grid capacity. Watch the job numbers outside of the tech sector. If Tim Cook pledges $600 billion, but your wages are flat and your grocery bill is up, that money isn't for you. It's the admission fee for the Apple showroom in the boss economic world. I'm your host. Keep your eyes on the data and hold on to your wallets. The show is just getting started.